Stories.
Your freedom.
The Peter Schiff Show.
Welcome, everybody. This is Peter Schiff here at SchiffRadio.com. This open line Friday, no guests, just your calls for the next 2 hours. 855-4-SCHIFF, 855-4-SCHIFF. A lot to talk about, especially since I was absent yesterday when I was up in Canada, in Montreal. I want to thank to Thomas Woods for sitting in. I was able to listen to just little bits of the show yesterday. Unfortunately, I wasn't able to hear anywhere near all of it, but I tuned in for a little bit, and Tom Woods did a great job. He always does. And also want to thank Judge Napolitano, who was a guest on the show, also with Thomas Woods. If you didn't hear yesterday's show, you might want to check it out in the archives. Meanwhile, we got a lot to talk about today. I'm going to be going over the Herman Cain 999 plan. A lot of people have sent emails to me asking for me to really look this thing over and comment on it. And I have taken a look at it. And, of course, as they always say, the devil is in the details. And there are some devils in the details of the 999 plan, and we will be talking about that. Also, I want to talk about this conference, a press conference that was held by a bunch of Nobel laureates. You'll be very surprised at what was said and what was not said at that press conference. Also want to go over this op-ed that Robert Reich wrote. A number of you have emailed me asking me to comment on these 7 points that Robert Reich tries to make. And, of course, I am going to rebut all 7 of these outrageous claims made by the former Labor Secretary. So we're going to talk about that and a lot of other things, as well as taking your calls here at 855-4-SCHIFF. First, I just want to mention the markets continue to rebound. The Dow Jones up 120 points today. We did get some economic news. I don't really call it economic news. It was news on retail sales. I mean, that's not really economic activity when people go out and buy stuff. I mean, that's just natural. The economic activity is making the stuff that enables people to buy it. Unfortunately, a lot of what we're buying we didn't make, and so it really reflects economic activity going on outside the United States. But the retail sales came in stronger than what had been anticipated. September retail sales jumping by 1.1%. Of course, it's not adjusted for inflation, so some of the increase is generally the result of higher prices. But no doubt Americans are spending a little bit more money. One of the reasons that Americans are spending more money is because they're not making their mortgage payments. So if you're not making your mortgage payments, you have more money to spend on other things. Mortgage payments are not part of retail sales. So if you stop making your mortgage payments and spend the money at the supermarket or at the department store instead, that increases retail sales. Also, if you notice that credit card debt has really been rising, and so a lot of retail sales come at the expense of added credit card debt. And one of the reasons that I believe that Americans are so willing to use their credit cards these days is because they've already in their mind determined that they're not going to pay what they owe on their credit cards. And they figure, what the hell, in for a dime, in for a dollar, in for a penny, in for a pound, whatever the saying is. Because let's assume that you're a typical American who's got a negative net worth. And let's say, you owe $30,000 on your credit cards and you have no hope of ever paying it back. Well, you might as well run it up to $35,000 or $40,000. I mean, it's very easy to buy things if you know you're not going to pay for it. And, of course, there also might be a mindset out there that there's going to be a forgiveness of credit card debt, a bailout for people on credit card debt. But the bottom line is, if you already owe more money than you know you're going to pay back, and you know you're going to default, it's just a question of when you have to. If that is going to happen, you need to go out with as big a bang possible. I mean, why default on $30,000 worth of credit card debt when you could default on $50,000 worth of credit card debt? I mean, you're going to screw up your credit anyway. And in fact, a lot of people probably think, hey, I'm not going to pay this credit card debt. And once I do and my credit is ruined, I'm not going to be able to buy anything. So I'm going to buy as much as I can right now before my credit is ruined. Because it's all going to be free if I go out and buy a new plasma TV for $1,000 and I put it on my credit card. If I know I'm not going to make my credit card payments, I'm getting this plasma TV for free. So I do think there is a lot of that desperate, I got nothing to lose, so I'm going to use my credit card stuff going on. And that's also one of the reasons that retail sales could be rising when you have all this unemployment, when you have no home equity. This is not a sign that the economy is strengthening. It's simply a harbinger of how much weaker the economy is going to get. That being said, though, the Dow Jones is up about 120 points. We are really banging up against some overhead resistance here, but very close to a breakout of this consolidation in the stock market. We'll see if we actually get that. The dollar continues to break down as stocks are threatening to break out. The dollar index is now getting close to the key level that I think would indicate that it's that the high is in for this rally, which should have closed below 76. We're right now at 76.50. All the currencies are up across the board, but I'm looking mainly, too, at the euro. The European Union is out today with more news on the supposed Greek rescue, and I'm liking what I'm reading because what it's saying is that they're looking at imposing losses on Greek creditors by as much as maybe 70%, which I think is a very good thing, both for Greece and for the Eurozone, and a way to let lenders know that there is risk here. So I think if there is a big haircut on Greek debt and losses are pushed on the lenders, I think that is a very strong development for the euro. The euro today is trading above 138 right now. This is the highest the euro has been really since September 8th. So this is a big run. Remember, I said there are a lot of people short the euro, and they're going to be in for a world of hurt, especially if we get some type of credible plan, which is what I've been forecasting would happen. We get the euro back above 140, and it could be a pile to cover those shorts. Meanwhile, look at the bond market. Remember, Operation Twist was designed to bring down long-term interest rates. That was the Fed's plan. Well, what is the result of Operation Twist? It's backfired. The yields continue to surge on treasuries. Now, they're still low by historic standpoints, but we're now up to 2.25 for the yield on the 10-year. This is really the highest the yields have been since August 11th, well before the Fed announced Operation Twist. On the 30-year, we're back above 3.2%. That's about exactly where the 30-year was when they announced Operation Twist. So the 30-year is exactly where it was, and the 10-year has risen. And again, that was part of the twist, as they were flattening the yield curve, and that has in fact happened because the yield on the 10-year has risen more than the yield on the 30-year. But that is not what the Fed wanted. The Fed wanted to bring rates down to help people borrow money. Instead, rates are rising. And so obviously Operation Twist ain't going to get the job done. QE3 is up next as far as I'm concerned. Anyway, we will be right back. I got a lot to discuss. Hey, we've got all lines open here at Open Line Friday, so if you want to call 855-4-SCHIFF to get in the queue. We will be right back with the Peter Schiff Show here at Schiff Radio. It is Peter Schiff here at SchiffRadio.com taking your calls, and we do have quite a few people on hold. It was my mistake. I didn't have the board up properly, but again, if you do want to call, it's 855-4-SCHIFF. And, hey, I forgot to mention earlier this morning, crude oil, which is up close to $3 a barrel now, above $87. This is the highest that crude has been since, looks like, September 16th. So we're making a run. There is some overhead resistance in crude oil at around $90 a barrel. That's less than $3 a barrel away. We get above 90, it could be a quick move back up to 100. So much for the benefit of lower gas prices. Pretty soon we're going to be talking about higher gas prices once again. Anyway, before I go to the phones, I want to first talk about a press conference that was held the other day. I happened to catch it on YouTube, and you can see it up there. There was no way to comment. The comments have been disabled. It's too bad because there could be some pretty funny comments. But anyway, this was a press conference, I think, at Princeton with Nobel Prize-winning economists there to answer questions, right, about the U.S. economy, including the two most recent recipients of the Nobel Prize in Economics. So they were both there to answer questions. And I don't know, they had maybe 50 reporters there that were going to ask, this brain trust, right? These are the smartest of the smart, right? These are all the people that have won Nobel Prizes in economics. So clearly, these are the guys that know the answers, right? They've obviously spent a lot of time thinking about the economy. After all, they are economists by profession. So they've been thinking about the economy, thinking about our problems, and of course they're here for a press conference. So clearly they had some extra preparation because they're going to a conference to answer questions from the press, about the economy. After all, I'm assuming they know that they're going to get questions on the economy. I mean, they're Nobel Prize winners in economics, so I'm assuming they don't think they're going to be getting questions, on sports or, on the arts or, film or stuff like that, right? I mean, they pretty much know that they're there to talk about the economy and, the U.S. economy, obviously, because it's a press conference in America. Anyway, so the first question that's really asked from the audience, and we're going to play that question, and the first guy asking a question wants to know, basically, hey, what's going on in the economy? Or do you agree with what the president has done? Do you agree with the Fed? What's your take on the economic situation? Very reasonable question. So let's hear this question. It's cut number 11.
I wanted to see your opinion about what the government has done so far in the United States to support the economy. If you think it has been appropriate, how can we actually support the economy, create jobs? Those questions everybody are asking themselves.
Okay, so that's just a question. All right, now, very legitimate question. All right, so let's hear how Professor Chris Sims, who is Christopher Sims, he's a professor at Princeton University, 68-year-old, a co-winner of the Nobel Prize for Economics. I think he just was announced the winner, I think it was just last week. So he's been asked a poignant question. What do you think about the U.S. economy? Have we done the right thing so far? Should we do something different? What do you think? Here is his carefully considered response. Here, cut number 12.
I think part of the point of this prize and the area that we work in is that that answers to questions like that require careful thinking, a lot of data analysis, and that the answers are not likely to be simple. So that asking Tom and me for answers off the top of our heads to these questions is, you shouldn't expect much from us.
All right, so first of all, I was hoping that we captured in the sound, but we didn't. So let me just set the stage for you. Before he answered that question, or rather didn't answer that question, there was a very large and noticeable pause because there was a bunch of blank stares, not only from this professor, but from everyone on the panel. And the press, the members of the press that were there broke out in laughter. And so before he even answered this question, the whole room was laughing at the fact that nobody could come up with an answer. And only after a long, pregnant pause and a bunch of laughter did Professor Sims opine. And basically what he said was, hey, these are complicated questions. You can't expect me to answer them off the top of my head. What do you mean, off the top of his head? This guy is a professional economist. You telling me that for the past 2 or 3 years, he hasn't even thought about the U.S. economy? He hasn't even considered whether or not what the government has done or what the Federal Reserve has done is the appropriate response, whether or not maybe we should have done something different. He hasn't even spent any time thinking about, what he would propose. Not a minute off the top of my head. I mean, he comes to a press conference on economics. Again, didn't he think he was going to get asked a question about the U.S. economy? I mean, as if he hadn't already prepared, he would have at least prepared yesterday and thought about these things. But how could you even believe for a second that he had never even thought about this issue? After all, even those second graders had thought about the economic crisis, right? And they even have some answers, right? They came up with stuff like glow-in-the-dark pants. This Nobel Prize winner in economics, he didn't even have that. He didn't even have glow-in-the-dark pants. He had nothing. You know what he said? He said that he needed time to compile all the data into a complicated program, run it through some kind of models, and come up with some idea. I mean, if he actually understood any economics, he wouldn't have to do that. But, of course, why didn't he already do it? If he can find a solution to our economic problems by crunching numbers through some program, what's he waiting for? It's been over 2 years. This guy's got a Nobel Prize in economics, yet over the past 2 or 3 years, he hasn't even spent 1 minute thinking about the economic problems of the United States or trying to figure out what his answer might be. Now, after he basically says, I can't answer the question, you can't expect me to answer the question off the top of my head, because, of course, I haven't thought about it at all. You know, don't put me on the spot here at a press conference about the economy and expect me to answer a question on the economy. But anyway, listen to what his buddy, right, this is his co-winner of the Nobel Prize, Professor Thomas Sargent from NYU. Listen to what this great economic mind has to say. Cut number 14.
Yeah, I don't have much to add to that. Maybe I was hoping you were going to ask about Europe,
I think one of the privileges of being a Nobel laureate is if you want to answer a question about Europe, you can do that.
One of the other privileges of being a Nobel laureate is you don't have to know anything about economics. So after the other Nobel Prize winner says he's got nothing, he hasn't given any thought to our economic problems and he has no solutions, the other guy says, yeah, I got nothing to add. And then he comes in and says, I was hoping you'd ask me about Europe. About Europe? What about America? I mean, this is an economic conference in the U.S. about America. It's not about Europe. Of course, later on, someone does ask about Europe, and he doesn't have an answer there either. Anyway, this real stuff is unbelievable. You can see the whole charade up on YouTube. You know, if they'd have had me up there, I don't have a Nobel Prize, but I do have answers, and I can make them off the top of my head, you know, because I have thought about this stuff, and I do have valid criticisms of Bernanke and the government, and I have real solutions based on a real knowledge of economics. I may not have a Nobel Prize, but I got some street smarts. Anyway, we'll be right back. We'll be taking your calls here at SchiffRadio.com, the gold standard in talk radio. And this is Peter Schiff here at SchiffRadio.com. And before the break, we were talking about the Nobel laureate press conference in which none of the Nobel laureates really came prepared to answer any questions about the economy or, you know, what to do about it. But actually, the one Nobel Prize winner that I mentioned, was it, no, not Sargent, the other guy, Chris Sims, he actually did come back and he did say something to the effect that he endorsed Ben Bernanke's 0% interest rates and quantitative easing, basically said that, hey, accommodative monetary policy is the right thing to do, and that's basically it. But here's I got a little sound of him basically, you know, endorsing Ben Bernanke, but nothing really to add. Here, this is cut number 13.
My own view is that what we ought to do is the kind of thing that Chairman Ben Bernanke has urged the U.S. government to do: make good long-run plans for resolving our budget difficulties without imposing severe fiscal stringency in the short run, and that accommodative monetary policy is a good idea. But these are not very original ideas. I think 80% of the economics profession would agree with this. The problem is to figure out how in the real world to get these things done.
Yeah, you know, the problem is, though, that 80% of the economists don't have Nobel Prizes. So you would expect that the guys with the Nobel Prize could come up with something other than, hey, print money, and say that 80% of the economists who don't have Nobel Prizes, you know, would agree with printing money. He doesn't come up with anything else. And, you know, of course, he's saying, yes, we need to reduce the deficit in the long run, but we need to have a bigger deficit in the short run. That's what he's saying, but we don't want any fiscal stringencies in the short run, meaning, yes, let's talk about reducing the deficit in the long run, but let's have a bigger deficit in the short run. In other words, yes, let's talk about going on a diet in the future, but let's stuff our faces in the present and actually put on some weight while we're just pretending that one day we're going to go on that diet. But anyway, let me go to the phones for a while. We got a lot of people who have been hanging on. First up is Rob in Rochester, New York. Rob, welcome to the show.
Morning, Peter. How you doing?
Good.
I got two questions. Last fall, you wrote an article called QE2, referring to the Queen Elizabeth and interest rate spikes ahead, which is a good analogy to the iceberg. But I was wondering, it's been close to a year, and interest rates have done nothing but dive. I was wondering if you see that continuing, for another year, or does the Fed have to step aside for that to change?
Well, rates have been going down, but they've been rising the last week or so. So we've recouped a lot of or given back all the gains that we had post Operation Twist, but we haven't had a big spike up in interest rates at all. And I think the one thing that's caused interest rates to fall is that many people that were expecting an economic recovery, have admitted that they were wrong, and a lot of the people who were expecting recovery were shorting bonds, and so when the economy didn't recover, they bought bonds. Now, if you remember, I have never expected an economic recovery, but I think interest rates are going to rise despite the fact that the economy is weaker. That I still believe is what's going to happen, but the conventional wisdom is that is impossible. So I think you are still getting some short-term pressure on bonds or interest rates being exerted from a lot of people that don't understand what's going to happen. But I think the interesting thing is the Fed is not able. The Fed is trying desperately to get interest rates to come even lower, and it is failing. So it is certainly possible that the big spike in interest rates could happen in 2012. And if the U.S. dollar breaks down, and I believe that could happen, if we get a big rally in the euro, a short covering rally on a resolution of the European problem, at least the short-run resolution, we get a big rally in stocks, a rally in foreign currencies, a rally in commodities, precious metals, oil, and stocks, the dollar should get clobbered. And then if the dollar breaks down, I think that could take bonds with it. And, of course, if we do get a big rally in the short run in stocks and commodities, I would expect the bond market to sell off. So if we can get a sell-off in the bond market and get the yield, let's say, on the 10-year back in the 3 to 3.5% range, then it's in a position where in 2012 maybe we start to see a bigger increase. If we get through, let's say, 4% on the yields again, then it could be off to the races. And I think that when yields start to rise, it's going to happen very quickly. Now, the government, the Fed, when they see that happening, of course, they are going to try their best with QE to stop it. The question is, for how long will they succeed? And, of course, they only succeed in slowing down the rate of increase in interest rates at the expense of making the ultimate high that much higher, because the more money they print to slow down the rise in rates, the more inflation they create, and ultimately the higher rates are going to have to go as a result.
Right. Completely makes sense. Also, on a different topic, Ron Paul, I think also last fall, forecasted sort of a Soviet-style economic breakdown. Do you see that in our future as well as the dollar continues to decline?
You mean a disintegration of the union where states are seceding or something like that?
In some form, yeah.
I hope it doesn't get that dire. I mean, that's not my forecast, but certainly if we continue on this path, if it's unrelenting, if the government keeps on repeating these mistakes, eventually there's going to be some states that are going to want out. They're not going to want to just sit there and take it. So there will be this pressure if we don't ultimately have a 180-degree change of direction in this country. But I don't see immediately in the next few years, a credible movement by states to succeed. But in the long run, that will happen if we don't address these problems in an effective way, which is the opposite of what we've been doing.
Right. Very good point. Also, one quick comment. I tried to convince my mother to open an account with Euro Pacific, and she heard the word euro and immediately looked at the headlines in the newspapers and, talks about the demise of Europe and all that. And I was wondering if you ever ran into any branding issue like that.
No, I don't think so, but maybe. I mean, that's a point. Maybe people are worried about the euro and they're worried about Euro-Pacific, but no, I mean, we've underrated the euro as a currency in our accounts and our portfolios for a long time. We have some exposure to euros, but the vast majority of our investments are denominated in currencies other than the euro. So, if your mother is concerned about the euro, that doesn't have anything to do with Euro-Pacific. Euro is more European. I mean, it's basically we invest in Europe and the Pacific Rim is our focus. And but you can assure her that even if the euro were to implode, it doesn't mean that my firm is going to go under, and nor does it mean that all we do is invest in euros, because we don't.
Indeed. Okay, thanks for taking my call.
Hey, thanks for calling. Next up is Herman calling from Queens, New York. Herman, welcome to the show.
Yes, Peter, can you hear me?
Yeah.
There's something that's happened that not a lot of people have made a big deal about, which I think is a really big deal. Mitt Romney actually came out and picked his foreign policy team, and they're loaded with nothing but neocons and rhinos. I mean, there's, I believe, 6 people from the Project for a New American Century, which is the think tank that gave us the Iraq War, which were pounding the table for the Iraq War back in the late 90s. There's an ex-vice president from Blackwater that's part of his team. Is Michael Hayden, former head of the CIA and the NSA, who gave us phone taps. There's Michael Chertoff, the guy who gave us body scanners. I think this is a big deal. I don't know why nobody's making a big deal about it. And he gave a speech of Mitt Romney not too long ago talking about how this needs to be the new century for America. And I've heard all this before, and I've read it in many books, and I know that you don't believe, in quote-unquote conspiratorial ideas, but I'm terrified when I see this, because I've heard this before, and a new American century, I mean, they've been talking about a 100-year war for a very long time, Peter, and people need to make a big deal about this. You need to get this to Ron Paul. Everybody needs to be running around and screaming off of
the fact that Romney is an establishment guy that's not news. I mean, he's the quintessential establishment candidate, combining government and Wall Street, and he's status quo. I mean, that's one of the reasons that I'm not a fan of Mitt Romney. So I don't think what you're saying is anything new. No one is going to be surprised by the fact that he's an establishment kind of guy with mainstream types of policies. I mean, that's Mitt Romney. I mean, that's one of the reasons that he really can't gain any real popularity beyond the support that he has. I think people know it. But anyway, it's good for you to point it out. Thanks for the call. Next up is Mike calling from Little Rock, Arkansas. Mike, you're on.
Hey, Peter. Thanks for the. I've got a quick question for you. I read your book back in '06 and started buying physical gold, and I just did it here in Arkansas, paying cash mostly for it, and I've done that over the last 5 years, and I've acquired quite a bit. My fear is, in a few years, I'd like to pay my house off, and at this point, I have enough to pay the house off if I wanted to, but I don't want to. I want to wait 5 or 6 years and let gold continue to go up. But when I do sell it, I'm going to run into a situation where I'm going to have a ton of cash. And how do I get that back into the banking system? Right now when I'm buying it, I can't go to the bank and take out $10,000 without filling out a form explaining to them why I'm taking out that much cash. So my fear is, how do you reintroduce your money back into the system in the future?
You're talking about proceeds from selling a house?
No, on the gold, say 5 or 6 years when I sell all the gold that I've acquired, I will most likely sell it as I acquired it, and I will receive cash. How do you get that money back into the system?
Well, obviously, it's still in the system. You can, it's not illegal to buy and sell gold. Obviously, if you want to stay on the good side of the IRS, you'll report the gains and pay your taxes. If you're asking me, how do I get the money back into the system without paying the capital gains taxes? How am I going to explain where I got all this money? Yeah, that's a problem. If you're not going to pay taxes, and I'm not advising you not to do that, but if you sell your gold and pay your taxes, hey, there's no problem. I mean, that there's an explanation of where the money came from. And of course, one of the problems with gold is that when you pay the taxes under the current system, you're going to be paying ordinary income taxes, not capital gains. Now, if we get a reform of the tax code, if we get an abolishment of capital gains, hey, then you won't have that problem, right? You'll just be able to sell your gold and pay no taxes and invest the money as you see fit without any concern. But that's your only real concern. It's, how do you do it without paying taxes? And, Anyway, thank you for calling. Look, if you want to stick around, I don't know if you have another follow-up. We'll be right back on the other side of this break. This is Peter Schiff on SchiffRadio.com. Welcome back. This is Peter Schiff here at SchiffRadio.com, and we are taking your phone calls live on this Open Line Friday. On the phone is Nick, calling from Tempe, Arizona. Nick, welcome to the show.
Thanks. My question is, one of the stronger arguments that I hear from people who are opposed to unrestricted free markets is the idea of kind of market power, that eventually firms will create monopolies and be able to control a market. Is that something that concerns you, and do you think the government has any role in creating?
Well, you can't expect me to just answer that question off the top of my head. Well, actually, you can. See, I don't have a Nobel Prize in economics, so I can think about these things. But no, I'm not concerned about that. I don't believe that in a free market you really have to fear monopolies being formed. I think it's governments that create all the monopolies through special privileges and through subsidies and barriers to entry that the government erects. In a free market with competition, I don't think monopolies are formed unless the monopolist is delivering the best product at the lowest price, in which case, who cares? The bottom line for me as a consumer is I want innovation and I want low prices. And if I can get that from a single provider, then that's fine with me. But what I don't want is just to have competition for the sake of competition. I want competition for the sake of low prices, innovation, and high quality. And so history has shown this, that's really, it's government intervention that creates monopolies, not capitalism.
Okay, because I guess the argument that people kind of bring to me that I have a hard time arguing is that, if there's one firm that's very large, that it can take advantage of economies of scale to...
Right, but if it takes advantage of economies of scale to deliver lower prices to the consumer, then what's the problem? Why should we be concerned with that?
Well, just that they could, if someone new tries to enter the market, they can lower their prices, drive that person out.
Yeah, now that is the myth of the predatory pricing, and the reason it doesn't work is, let's say there is a company that has 100% of the market, they have a monopoly, and they're giving their customers, a good deal. Or maybe they're overcharging their customers somewhat, and because they're overcharging their customers, there's room for somebody to come in and try to compete with them with a lower price. The argument is, well, then the monopolist is going to slash their prices to a loss to drive this new entrant out of business. The reason that doesn't happen is if you've got, let's say, 99% of the market, and this entrant comes in and takes 1% by undercutting you. If you try to drive that company out of business by operating at a loss, the losses that you have are going to be enormous because you're going to take a loss on 99% of the market. You have an enormous market share. If you start selling at a loss, it's enormous. It's nowhere near the 1% that you're losing by allowing the competitor. So the way it works is if you are a monopolist, no matter how much you threaten to try to drive your competitor out of the business by selling below cost, if anybody actually tries to compete with you, the best thing that you can do is accommodate him. Just keep your 99% and allow your competitor to have his 1%. And of course, then he doesn't get driven out of business. And then he gradually gets bigger and bigger and bigger, and more people come in, but it's never in the monopolist's interest to lose money on enormous capacity, because then the losses are huge. And even if you're successful, even if you succeed in driving out that competitor, the minute you raise your prices back up again, now another competitor comes in. And of course, now you're wounded. You've just had all these enormous losses from fighting off this one tiny competitor. You've lost a fortune, and now you're going to do it again? You're in a weakened position, so it just doesn't work. People can have all these theoretical worries about free market monopolies, yet they don't happen. But what does happen all the time is the government gets in and creates monopolies or oligopolies with licensing and strict barriers to entry. If the government was really worried about monopolies and wanted competition, the government would get out of the way and allow businesses to flourish. Instead, it does the opposite. But anyway, hey, thank you for the call. I want to move along to this Robert Reich piece. He came out with, this is last week, or maybe it was earlier this week. Robert Reich takes on the 7 biggest economic lies told by the GOP. And he's got this article, and he's going one by one over the lies. The only lies that are being told are by Robert Reich in the way he's trying to discredit what the Republicans are saying about raising taxes. So here's number 1 on his list. Trickle-down economics. Robert Reich, tax cuts for the rich trickle down to everyone else. Baloney, says Robert Reich. And evidence that trickle-down economics doesn't work. Robert Reich says that, Ronald Reagan and George Bush lowered taxes on the rich, yet over this period of time, real wages adjusted for inflation for the middle class have declined. Both of those statements are true. But there is no cause and effect. You can't say just because Reagan and Bush lowered taxes on the rich and the income of middle Americans adjusted for inflation went down, you can't say that one caused the other. Not at all. In fact, maybe had the Bush tax cuts not come in, or the Reagan tax cuts, maybe real wages for average Americans would have fallen even more. The fact of the matter is, the reason that American wages are coming down adjusted for inflation is because of all the big government programs that Robert Reich likes so much. The big government programs that Ronald Reagan didn't get rid of, that George Bush didn't get rid of. In fact, they expanded them. It's big government, not tax cuts, that are responsible for the plight of the middle class. And one of the reasons that inflation is eroding away the value of wages is because the Federal Reserve is creating it to monetize all these debts, to spend all this money on all the government programs that Robert Reich loves. Anyway, we've got 6 more points to go over. We're not going to be able to do it in this segment. We will do it when we come back. In addition, in the second hour, we're going to be going over the 999 plan by Herman Cain, and we're going to take a look at that more closely. So make sure and stick around. This is Peter Schiff at SchiffRadio.com.
Your freedom. The Peter Schiff Show.
And this is Peter Schiff on SchiffRadio.com. Hour 2 of the Peter Schiff Show is underway now. And at the end of hour 1, I started dissecting Robert Reich's 7 lies told by the GOP. It's actually 7 lies told by Robert Reich. And we were talking about lie number 2. I finished lie number 1. Number 2, according to Robert Reich, higher taxes on the rich would hurt the economy and slow job growth. Well, as his example that this is false, Robert Reich points up that in prior periods of history, up until 1981, the highest marginal tax rate was 70%, and that under Dwight David Eisenhower, it got as high as 91%. And he says that we had a stronger economy back then, therefore that proves that high taxes on the rich don't hurt the economy. Again, his logic is faulty. You cannot simply say that because taxes were high back then and the economy grew better, that the economy grew as a result of taxes being high. Look, there are a lot of other things that were going on back then that aren't happening right now. You might as well say, hey, back under the Dwight Eisenhower administration, there were no television sets. or actually they started coming in, but, and now, well, certainly there were no cell phones back then, and the economy grew faster. Therefore, cell phones are hurting economic growth. After all, the economy was growing faster without cell phones than it is with them. There is no causal relationship between those two. The fact of the matter is the reason that we had more economic growth back then is because we had a lot less government back then, despite those high taxes. And the reality is, even though the taxes were that high, the effective rate was a lot lower because of all the deductions. Nobody had income that was taxed at 70%. All the income was expensed. And, of course, it was a lot easier back then to cheat on your taxes. I mean, it was so hard for the government to figure out if you were earning money. There were no 1099s. There were no computers. The government only knew what you told them. So a lot of people that were earning a lot of money simply weren't reporting it. They weren't paying taxes on it. They had all kinds of shelters, all kinds of ways to deduct things. That doesn't exist today. The fact of the matter is, I would bet if you took the typical upper income earner, small business owner who had a high income during the Eisenhower administration, they paid a lot less in taxes than the counterpart would today. I mean, his facts are just plain wrong, number one. But again, the reason that the economy did better before we had, in the past than now is because we had less government, we had fewer regulations, we had sound money, we had a higher savings rate. There are a lot of other factors that are responsible, not simply the fact that, or not even the fact that taxes were higher the rates were higher than they are today. Here, number 3, shrinking government generates more jobs. Wrong. Robert Reich says shrinking government doesn't generate more jobs because when you shrink government, you have to fire government workers. Yes, you fire government workers. Shrinking government means we have fewer government jobs, but more private sector jobs. Because where does Robert Reich think the government gets the money to pay its employees? It gets it from taxing the private sector, either directly or indirectly through borrowing or inflation. But either way, money to pay public sector workers comes at the expense of money that otherwise would have been available to pay private sector workers. No argument with me from Reich that if we cut government spending, we will get fewer government jobs. Absolutely. But if we get rid of some of these government jobs, we have more resources for even more productive private sector jobs. That's the point. We don't want government jobs. Government jobs make us poorer. We want private sector jobs. They make us richer. Anyway, let's go to number 4, the fourth myth, according to Robert Reich. Cutting the budget deficit now is more important than boosting the economy. He says it's untrue. I say it is true. See, Robert Reich thinks that the way to grow the economy is for the government to spend more money, and so if that means a bigger deficit, so be it. According to Robert Reich, if we cut back on government spending to shrink the deficit, that it's going to hurt the economy. It's the exact opposite. It's the deficits that are stifling the economy. It's the money that the government takes out of the capital markets to finance its deficits that is preventing the economy from growing. So Robert Reich is wrong again. If we cut government spending now, we will get more economic growth because we'll free up the economy. We'll unshackle it. We will remove the burden of having to finance all these deficits. Anyway, number 5, Medicare and Medicaid are the major drivers of budget deficits. He says it's wrong. He says it's not Medicaid and Medicare. The problem is that health care costs are rising so fast. Well, duh. Why does Robert Reich think health care costs are rising so fast? Actually, let me get that back, because what he thinks is immaterial. I'll tell him why the health care costs are rising so fast. It's because of Medicaid. It's because of Medicare. It's because of the government involvement in health care. It's because of all the subsidies that we put into the health care. It's because health insurance premiums are tax deductible, whereas wages are taxable. It's everything the government does to subsidize health care that are driving the costs of health care and insurance through the roof. It's not the free market. Anyway, number 6. Sixth myth, according to Robert Reich. Social Security is a Ponzi scheme. Don't believe it, according to Robert Reich. Well, then what is it if it's not a Ponzi scheme? He says, hey, it's not a Ponzi scheme because it's solvent for the next 26 years. Well, what happens after that? So it falls apart in 27 years? If it's not solvent in perpetuity, then obviously it's a problem. And, of course, why does Robert Reich think that Social Security is solvent for the next 26 years? Because he thinks the government could borrow money for another 26 years to pay the benefits. Well, that's not solvent. It's not solvent because it can issue government bonds and go into debt. What if the government can't sell those bonds? Of course, it's a Ponzi scheme, but Robert Reich doesn't understand that. And here's number 7. There's a myth. It's unfair that lower-income Americans don't pay any income taxes. He says that's wrong. Well, wait, so why is it fair that there are people that pay no income taxes at all? Now, he says it's not true because, after all, the lower-income people have to pay payroll taxes and sales taxes. Well, you know why they have to pay payroll taxes? To support Social Security that he claims isn't a Ponzi scheme. The reason that the poor have to pay all these Social Security taxes is because Social Security is a Ponzi scheme. Because the wealthy or the retirees who are collecting Social Security, the money that they paid in is gone. And so the only way to get the money is to tax the poor, the working people, the very people that Robert Reich is pretending to champion. He's championing them, but at the same time, he's also championing the Ponzi scheme of Social Security that is enslaving them. But what is unfair about having a tax that half Americans don't pay is because they have no resistance to raising it. That's what's not fair. One American should not be allowed to vote to raise the taxes on another American. If we're going to have higher taxes, everybody should have a skin in the game. That way, it won't be as easy for the government to raise income taxes if every voter is going to feel the pain. Then we'll have some resistance, and we'll have spending cuts instead. Anyway, I will be right back. This is Peter Schiff here at SchiffRadio.com. This is Peter Schiff, SchiffRadio.com. We're going to be going back to the phones. On hold is Andrew calling from Colombia. Andrew, welcome.
Hey, Peter, how are you?
Good.
Hey, even though I'm not a U.S. citizen, I do have a great deal of admiration and love for the USA. And I'm sad to see that its ideals are completely twisted and corrupted, and now in the hands of brainwashed and ignorant people with power, nonetheless. And it's a good thing that there are people like you educating more and more people every day, so I thank you for that. And I have two quick questions. First, what do you think of oil stocks and their performance in the future months and days? And the other is about the dollar, that we know that's going to collapse. But what about the euro? I mean, will they make the euro collapse as well? And what's going to happen with the rest of the world currencies? Are they going to make it stronger, weaker? Are they going to collapse as well?
Well, yeah. First, on oil companies, I mean, I remain bullish on that sector, and it's part of the stocks, or some of the stocks that we recommend at Euro Pacific Capital to our clients, and in our managed types of accounts. We own an overweighting in the energy sector, and we have oil companies that we have around the world. I'm very bullish, and in fact, I've been commenting on that today. Oil prices today are up about $2.50 a barrel. We're back close to $87 a barrel. I think that once we get through about $90, where there's some overhead resistance, I think we could have a big run higher in the price of oil, back above $100 a barrel. The high that we had earlier in the year, oil got up to about $115 a barrel. I think we can go back up there. Probably not this calendar year, although it's possible, but I think certainly in 2012, it's my expectation that oil prices will take out that high. And if you look at where Brent is, I mean, Brent is still above $110 a barrel. I mean, that contract has really held firm, even though the West Texas had pulled back into the mid-70s, although we've recovered quite nicely from those lows. So I expect oil to keep going up. As far as currencies are concerned, I mentioned earlier in the show, my expectation is for a rally in the euro because I think there is a lot of negative sentiment on the euro. I think there are a lot of people short the euro, and I think they're going to be covering. Long term, I still think the euro will underperform a lot of other currencies in the world because I don't believe that the European problems are over, far from it, and nor do I believe that what they're going to come up with in the next days or weeks or months, whenever they come up with a resolution of the current sovereign crisis, even though I believe that it might fool the markets for a while into being complacent with respect to the euro, I don't believe that it will be a real workable long-term solution. I think that there will still be more problems in the future, but I do believe that it will basically put the European problems again back in the back burner and bring the U.S. problems up to the front, and there will be a lot more attention paid to the problems of the U.S., which I think is going to be a big concern here, which is why I've said that a lot of the U.S. politicians are trying to blame our problems on Europe, saying, hey, our economy is suffering because of Europe. Hey, I actually think that we're catching a break. I think because of Europe, we're getting lower interest rates and a stronger dollar, and once Europe gets its act together, then the U.S. is going to suffer. It might not mean that our stocks go down. I mean, we can get a rally in the stock market, but a rally in the stock market doesn't mean that the economy is improving. Far from it. I mean, you can have a huge rally in the stock market with the economy getting worse, especially if the Fed is fighting the weakening economy with quantitative easing, which is good for stock prices, but bad for the economy and bad for the typical American who's watching the value of his savings and his wages evaporate.
All right, and what do you think about the other currencies? What about the other world currencies like Brazil and South America and all that?
Yeah, look, I think the emerging market currencies are ultimately going to rise quite a bit, especially when they stop accumulating all these dollar reserves and allow their currencies more room to rise. But I've said many times that I think that all the world central banks are too loose, and for the time being, I still think that gold is going to be a better store of value than just about any currency, and so I expect the price of gold to be rising in all currencies, although it will rise more rapidly in the dollar, for example, than it will in the currencies that you just mentioned or many other currencies. And, of course, we just have this special report. If you want to download it, it's up on our website. Also, it's got a special website of its own. I think it's newcurrencyreport.com, but it's also on Europac.net. It's my 5 favorite currencies for the next 5 years. Download that report. It is free. Anyway, thank you for the call. Hey, also, while it's on my mind, my next trip, I'm going to be going down to New Orleans for the New Orleans Investment Conference, October 26th. If you're not currently registered, make sure and do so. And if you register and you let people know that you heard about it on Schiff Radio and you want to get the promotional special, not only do you get a discount off the price, but you get 3 free copies of my books, How an Economy Grows and Why It Crashes, Little Book of Bull Moves, and Crash Proof 2.0. And again, by the way, the paperback edition of Crash Proof 2.0 coming out next week. In fact, this is the first time that any of my books have been released in paperback. So I guess the paperback means it's a lower price, so it's a good opportunity to get some of your friends copies of Crash Proof 2.0 in paperback form. Anyway, I've been talking about the Herman Cain 999 plan, and I've been mentioning that I'm going to talk about it. Now I want to actually look at the details of the 999 plan and compare it to what we've got now. First of all, what we have now is a complete monstrosity. The current income tax, payroll tax, corporate tax is awful. And just about anything is an improvement on that. And so Herman Cain's 999 plan, for some real flaws that I'm going to discuss, I think net is better than what we got now, although I don't believe that Herman Cain has really done a good job of honestly representing the impact of the 999 plan on workers. And I think that's going to come back to bite him, because once the details are more thoroughly exposed, he's going to have a lot of questions that need to be answered. And I think this is a good thing, because, Herman Cain has risen in the polls, and I said this was going to happen. I was impressed by his debate performances. I said he would catch on. He has. He's actually in some polls now in the lead, number 1 in the GOP race. So Herman Cain has done us a favor, if you're a Ron Paul fan, because he's taken support away from Romney, he's taken support away from Rick Perry. Now Ron Paul's got a chance to convert these people. Now that they've already decided they don't want Perry, they don't want Romney, they've temporarily moved over to Herman Cain. Now they're up for grabs. Ron Paul has an opportunity to get these voters, and I think the way he does it is by coming up with a plan that is better than 999. That way, Herman Cain can't say he's the only one with a plan. Ron Paul can say, I got a better plan, and he can point out the problems with the 999 plan and force Herman Cain to deal with that issue. Because after all, and as I said, I'm going to discuss this in a minute, there are some big problems here. But first, I want to look at Art Laffer. You know, he endorsed the 999 plan on Fox News, and Herman Cain, you know, has been pointing out Art Laffer, using him as an example of an economist that he's relying on, or an advisor. And you know, I don't know that he wants to endorse Art Laffer to that extent, because Herman Cain has already admitted in interviews that he was surprised by the financial crisis and the housing bubble. And I'm not going to fault him for that. I mean, a lot of people were surprised by it. But Herman Cain is claiming that, hey, he's a good executive. He can appoint people that understand things that he doesn't. Well, if he was surprised by the economic crisis, why have an economic advisor who was just as surprised? I mean, what Herman Cain should have done is said, hey, I missed the economic crisis and the housing bubble. Let me find an economic advisor who didn't. Let me find somebody who got right what I got wrong. Instead, he's relying on somebody who was just as clueless. So that doesn't show good decision-making. But anyway, as soon as we come back, we are going to get into this 999 plan. You are listening to the Peter Schiff Show here at SchiffRadio.com. And we are back. This is Peter Schiff here at SchiffRadio.com, and we're going to talk about the Herman Cain 999 plan. And before I get into the plan, I do have Art Laffer's comments on Fox News yesterday in support of 999. Let's see what Art Laffer had to say, cut number 10.
I think 999 is a wonderful plan. I think a lot of the candidates have very good plans for tax reform, but I love the 999 plan. I think it's a great first step.
Why is it a good plan?
Well, first place, what you really want to do on taxes is you want to lower the tax rate and broaden the tax base. So you provide people with the least incentives to evade, avoid, or otherwise not report taxable income, and you give them the least places to which they can escape. What you really want is a very efficient tax code that people don't try to cheat on or get out on, and his plan does exactly that. It broadens the base dramatically, and it lowers the rate. And it's especially important getting rid of the corporate rate, which is really a silly tax today.
All right, well, Art Laffer is certainly partially right. There are a lot of positives in the idea behind the 999 plan. Certainly, getting rid of the corporate tax is a great idea. There should be no corporate tax, and in fact, the 999 plan does get rid of it, because what the 999 plan does, or it doesn't get rid of it, it lowers it to 9%. But what it does do is reduce the double taxation of corporate dividends, because corporations are allowed to deduct from their taxes anything they pay to their shareholders in dividends. So right now, dividends are taxed at 15%. The corporate tax rate is 35%. So guys like Warren Buffett, if they own stock in Berkshire Hathaway, and if Berkshire did pay a dividend, you know, the effective tax on Warren would be 50%. The 999 plan does reduce that combined tax to 9%. So it is a substantial reduction in the corporate rate of income tax, which is a very, very good thing. It also does move the nation in the direction of a national sales tax. And in fairness to Herman Cain, I read on his website, his 999 plan is a stepping stone. He is hoping that we start with 999 and then ultimately we abolish the income tax completely and collect everything from a national sales tax, which is a significant improvement on what we have now, because not only would that move us to a consumption-based tax system, but you get rid of the IRS. You get rid of all the compliance costs. You get rid of the costs of taxing capital. You get rid of the hundreds of billions of dollars we spend every year to avoid or minimize our tax liability. All of that is a good thing. But as I said earlier, the devil is in the details, and the one devil that is in this plan is the fact that under the Herman Cain 999 plan, corporations or businesses cannot deduct from their taxes any of the wages they pay their employees. Now, what does that mean? If you're a corporation and you can't deduct your wages, that means you have to pay a 9% tax not only on your profits, but you have to pay a 9% tax on your payroll. Because whatever you pay in payroll, if I'm an employer and I pay one of my employees $100,000 a year, I need to send a check to the government for $9,000 on top of that $100,000. So in other words, This is a hidden payroll tax. Now, Herman Cain is saying that his plan eliminates the 15% payroll tax. It does, but it replaces it with a 9% payroll tax. Now, all of it goes on the employer, right? None of it goes on the employee. But where is the employer going to get the money? Well, he has to get it by reducing the wages of his employees by 9%. So what Herman Cain always says to try to defend his plan is, hey, we're replacing a 9% sales tax, let's say for people who aren't really earning, who are earning a little bit of money and they're not paying income taxes. And Herman Cain is saying, well, yes, we are going to impose a 9% sales tax on that individual, but we're going to get rid of the 15% payroll tax, so he's not worse off because he's not paying that payroll tax. That's actually not true, because you're only lowering the payroll tax from 15% to 9%. So the net savings is 6%, but the sales tax is 9%. So therefore, you're 3% worse off. So somebody today who is paying no income taxes at all, just payroll taxes, under the 999 plan, they see an increase of 3 percentage points. 3 divided by 15, that is a 20% hike in tax burden for people who are working at a level where they don't pay any income taxes. Now, what about people who are paying income taxes and payroll taxes? What happens to them? Well, they're still going to pay, they're going to get a reduction in their income tax to 9% from, with the higher tax, but their payroll tax is not going to go from 15% to 0. It's going to go from 15% to 9%. So the effective tax on wages is 18% under the plan. And then, of course, if that individual who is working and spending 100% of his income, then they're going to be hit with a 9% tax on the things that they buy. Of course, if they buy a bunch of used things, then they're not going to pay the full 9%. But, obviously a lot of the things that are being purchased are going to be subject to the 9%. But assuming everything was subject to the 9%, that means an individual is paying 27% of his total income in tax. That would represent a substantial tax cut for me, but that would be a tax increase for a lot of Americans. And unfortunately, Herman Cain hasn't explained it that way. See, Herman Cain keeps talking about the fact that he's eliminating the payroll tax, but he never brings up the fact that he is imposing a brand new hidden 9% payroll tax. So he's not eliminating it. He is simply reducing it from 15% to 9%. But in many cases, he's actually raising it, because the payroll tax only applies to the first, at least the Social Security part, not the Medicare part, but the Social Security part applies to just the first $100,000 and so of income. But this 9% tax is going to apply to all income. So if somebody is working for an investment bank and they get paid a salary of, $5 million, well, that bank is going to have to pay a payroll tax of $450,000 because they paid $5 million. Now, obviously, there's not going to be any hearts bleeding as a result of that, but the bottom line is, where does that $450,000 come from? It's a tax on that payroll. So we're not really abolishing the payroll tax. We are reducing it. And so the real tax on income, right, is not 9%. See, when he says 999, a lot of people think, hey, I'm working for wages, I'm only going to have to pay taxes of 9%. No, you're not. You're going to have to pay taxes of 18%. 9 plus 9 is 18. That's the minimum. Now, there are plenty of American families right now that are going to do the math and are paying less than 18% because they have deductions and things like that get eliminated. Now, eliminating deductions is a good thing. Don't get me wrong. We want to eliminate deductions. But the problem is corporations need to be allowed to deduct all of the wages that they pay. And if you do that, then you can be more honest about what the tax rate is. But it's not going to be 999. The 9 is going to have to be a lot higher. In fact, in order for it to be legitimate, that first 9 would have to be 18, and there wouldn't be as many fans of the plan if it were presented in that way. But the problem is that is the honest way. That is the way Herman Cain should be selling it. The fact that he's trying to hide the fact that the tax on wages is not 9% but 18%, I think is a window of opportunity maybe for Ron Paul to bring this up, especially if he comes out with his own plan. I've heard that he is working on a plan. Maybe he's going to release it next week. And the key is to not let Herman Cain own the issue of tearing up the tax code and getting rid of the IRS. That's a Ron Paul issue. But this plan is not everything that people like Art Laffer claim it is. I would say that net, is it better than what we have now? Yes, it's better than what we have now. It's certainly going to raise taxes on some people. It's going to reduce taxes on others. But it is a pro-growth plan. The economy will be better under 999 than it will be under what we've got now. Plus, the 999 plan does eliminate the estate tax, which is one of the worst taxes that we have, so we get rid of that. So that's another positive for 999. It also zeroes out the capital gains tax. But the fact that it has a hidden 9% payroll tax, 9% tax on wages, I think is the Achilles heel of the plan, and I think it's going to make it difficult for Herman Cain to defend it based on what he's already said. I think what we really need is to combine a reform of the tax code with a net reduction in taxes for just about everybody. Then it's a win-win. But the only way you can do that, the only way you can propose a reduction in taxes is if you simultaneously propose massive reductions in government spending. So any real plan, right, that reforms the tax code should also come together with a plan to reform spending, to reduce spending so that the government doesn't need as much tax revenue. And if it doesn't need as much tax revenue, then taxes don't have to be as high. But I will agree that if we reform the tax code in a way that stops punishing growth, that stops punishing investment, and that stops encouraging consumption and debt, if we make those reforms, the economy will grow more, and the government will collect more taxes on that basis. But that's not enough. We don't want to fall into the Reagan trap that the tax cuts are going to pay for themselves. They're not going to pay for themselves if the government keeps on spending, because then we lose the benefit of any additional tax revenue because it gets flushed down the government toilet. So we've got to reform not just the tax side but the spending side. And when that means, when I say reform, I mean reduce government spending. Anyway, we will be right back. We'll take some more of your calls here on the Peter Schiff Show on SchiffRadio.com. And this is Peter Schiff here with the final segment of the day and the week for the Peter Schiff Show. And again, the big problem with the 999 plan is it's not 999, it's 1899, because 18 is the percent that wage earners will pay in the combination of payroll taxes and income taxes, 18%. And then, of course, if they spend their salaries and they buy things subject to the national sales tax, they will pay another 9% on top of that. Now, of course, one of the other problems with the 999 plan is that even though Herman Cain hopes to eventually get rid of the income tax, he doesn't get rid of it with 999. He flattens it, he lowers the rate, he gets rid of a lot of deductions, but the tax code is still there, and it can still be raised by future Congresses. And not only do they now have an income tax that they can raise, but we've also put in place the mechanism for raising the sales tax. Now, what Herman Cain says that he has done is his plan requires a 2/3 majority to raise the rate. Well, that still means it can be done. And, of course, it doesn't take a 2/3 majority to repeal the provision that calls for a 2/3 majority. Congress, by a simple majority, can vote to get rid of the provision requiring a 2/3 vote to raise the tax, and so they get rid of it that way. So the reality is you don't need a 2/3 vote. Congress can do by simple majority. They can raise the income tax or the sales tax or both. So really what we want is a plan that permanently abolishes the income tax so it never rears its ugly head again. and we do want to replace it with a consumption-based tax. National sales tax would be my preference, but of course, I don't want a net revenue neutral. I want less revenue going to the government. I want massive cuts in government spending. That is how you reduce the tax burden on the American public. Anyway, let me go and take a couple more calls. Tony is on the line from Chicago, Illinois. Tony, welcome to the show.
Hi, Peter. Thank you for taking my call. I had a quick question regarding, I know you mentioned a lot of times that you keep a lot of your money in Bank of America. I was just wondering, are you just keeping money just so that you have enough cash flow to run your business, or would you have, other savings? Because I would think you would want to keep dollars if it's not to run your business, right? You would want to move to offshore or other currencies.
No, the money that I keep in cash is money to effectively run my business. When you operate a business, when you have a lot of payroll, you have to have cash to meet the payroll. I also have a lot of other obligations. I have net capital rules. I have to keep a lot of cash on hand because of security rules regulations. They require me to keep. So I might have to have a couple $1 million every day just sitting in cash just to satisfy the regulators because of the capital that is required for me to have in order to do my business. So I always have, significant amounts of cash, not because, I generally would want to keep it there. I don't. But it's because, A, I'm required by regulators to have a certain amount of capital, and B, I need cash flow to provide for my business and to make sure that I can meet all of my expenses. And, of course, when anybody's running a business, you can always have a slow period. It's always possible that there can be a month where my expenses exceed my revenue. What am I going to do then? I mean, obviously, I can't just tell my employees, sorry, you can't get paid. I can't tell my landlord, hey, sorry, you're not going to get your rent this month. I didn't earn enough in commission. So you've got to have money there to be able to pay the bills when the revenues are insufficient to do it. I mean, that is why, for a lot of businesses, this is a very tough thing. A lot of people don't want to run a business because they want to get money every month or every week. They want to be paid. They don't want to be on the hook for the rents and the salaries if the sales are not sufficient to generate a profit.
Okay.
But the reason I keep money at Bank of America versus other banks is because I'm convinced that when Bank of America fails, they're going to bail me out. If it was a smaller bank, I couldn't be as certain. But Bank of America is so big, and there's so much money from so many important politically connected people that there's no way that the government's going to let them fail. And even if they do let them fail, there's no way they're not going to bail out the depositors. So the moral hazard means I send my money to Bank of America rather than a more deserving bank that should get my money, and absent all this government protection would get my money. But because of the moral hazards provided by government, I'm sending my money to Bank of America instead. And so the weak get stronger and the strong get weaker. It is the exact opposite of Darwinism or capitalism, where we favor the weak at the expense of the strong.
Got it. Okay. I had another question if you have time. Her question is when the world lends us the money, right? I know we can borrow money for a lot of low interest rate. Why would the world lend us for that little money or for that little interest rate? Is it because U.S. dollar is the reserve currency and they can buy a lot of other stuff? Is that the main reason why?
Well, I mean, central banks are doing it. A lot of the buying comes from foreign central banks, and so that's just for political reasons. But, of course, if these foreign central banks decide that it's no longer in their political interest to buy treasuries, they're going to stop doing it. Of course, the Federal Reserve is a big buyer, and it's doing it to prop up the economy. It's not making a rational financial decision. Now, as far as other private investors, why are they buying treasuries at such low rates? It got me. I think a lot of them are doing it as a speculation. I think they're planning on selling. I don't think any of the private buying of U.S. treasuries is really planning on holding these treasuries till maturity. I think everybody who is buying treasuries is planning on selling them before they mature. But somebody is going to be caught holding the bag because somebody has to hold these things when they mature. So who's going to get stuck with the holding the bag when the music stops? Because when the music stops, it's a big, big drop. There are probably some institutions that buy treasuries to lock in, to offset other liabilities, to kind of match duration or things like that. But I think that there is no real demand for these from the point of view of people who just want to own them and clip coupons and cash them in when they mature. So people buying treasuries today, it's like people who are buying condos in Vegas, right? They were buying condos without any intention of ever living in them. They were going to flip them. And they were probably going to flip them to somebody else who also had no intention of living there. But eventually, someone's got to live in it. And someone's got to get stuck with it. And that's what's going to happen. You got all these people who are flipping these treasuries, all assuming they're not going to be there until maturity. But ultimately, somebody has to, and the market will implode.
Okay. Last thing, do you know if that babysitting law that California tried to pass? I think you said that it passed House already. Did it pass Senate?
Yeah, I haven't seen any more information on the California babysitting law, so I don't know that it's been enacted yet. I know it had passed one particular house there, but it's going to be interesting. I got to keep a check on that because that would be really a bad news for California if such a harebrained law were actually to be enacted. And the fact that you can have people in California, elected officials, vote for such a thing, it shows you the mentality. I mean, how stupid could people be? Well, that's how. Anyway, hey, thanks for the call. I'll see if I can squeeze in Gary in Florida. Gary, real quick, what's on your mind?
I inherited some coins, and before you...
Actually, you know what? I apologize. The music is already playing. Gary, just, I guess all you got to do is say hi. Call in on Monday. We'll try to get to your call right away on Monday. Anyway, that is it for the Peter Schiff Show this week. Don't forget to tune in again on Monday for another 2 hours of the Peter Schiff Show here on SchiffRadio.com, the gold standard in talk radio. Have a great weekend, everybody.